Hello, and welcome. I'm Professor Edmund Hallberg. In this conversation, I'll be asking questions, challenging assumptions, and trying to understand what recent economic signals really mean for everyday life in India.
I'm Dr. Lakshmi. I'm an analyst and researcher, and I study how macroeconomic systems, currency movements, and technology shifts translate into real-world outcomes for people and businesses.
India today is described in confident terms. Strong growth numbers, a stable banking system, foreign exchange reserves close to $600 billion. And yet, in December 2025, Reuters reported that the Indian rupee quietly slipped past 90 per dollar and briefly entered the 91 zone intraday. No emergency address, no national panic. So my opening question is simple but uncomfortable. If India is structurally strong, why did the currency still move like this?
Because a currency is not a moral judgment. It is a price. And prices move when incentives change, often quietly, often before most people notice. What happened in December was not collapse. It was a repricing of risk, driven by flows, hedging, uncertainty, and market mechanics. And the effects of that repricing don't stay on trading screens. They travel into households, businesses, and future opportunities.
Let's anchor facts before interpretation. What do we know with certainty?
From Reuters reporting, we know that in mid-December, the rupee touched roughly 91 rupees per dollar intraday, then recovered toward the high 89s after RBI-linked intervention and two-way flows. At the same time, India was not in recession. GDP growth was still above 7% in recent quarters. Inflation was moderating. Foreign exchange reserves remained near $600 billion. So this was not a balance of payments crisis like 1991. It was the market pricing near-term uncertainty. The myth is that record low automatically means failure. In reality, it often means adjustment.
Let's do mechanics, not slogans. Walk us through the drivers.
The cleanest structure is the balance of payments. Throughout 2025, foreign portfolio investors were net sellers of Indian equities. When FPIs sell, they sell rupees and buy dollars. That alone creates pressure. This is something economists like Raghuram Rajan have warned about for years. India is not weak, but it is flow-sensitive. Growth does not guarantee inflows. Predictability does. Reuters linked the December move to U.S.-India trade uncertainty. Markets can price bad news. They struggle with unclear futures. Global fragmentation and protectionism are risks even India's finance minister has publicly acknowledged. Currencies price uncertainty early. Importers and borrowers hedge currency risk. When depreciation is expected, they buy dollars forward. When many hedge together, forward premiums rise and dealers rebalance spot positions. This is not speculation. It is insurance. Non-deliverable forwards trade offshore. Most Indians never touch them. But expectations formed there leak into onshore markets. Reuters explicitly noted offshore pressure in December. Forward premiums rose to multi-year highs. Why? Year-end balance sheet constraints, swap demand, Dollar distribution frictions. Even if dollars exist somewhere, they don't always flow smoothly where needed. The RBI does not defend a number. It defends order. It intervenes quietly through spot sales, swaps, and liquidity tools to prevent disorderly moves, not to win headlines.
Pause here. Many listeners mix this up. Explain current versus capital account clearly.
The current account is trade, exports minus imports plus remittances. The capital account is money, investments, loans, portfolio flows. India's current account is structurally import-heavy because we import energy, electronics, and machinery. So the rupee often depends on capital inflows to balance that gap. When capital flows slow or reverse, the currency adjusts, even if exports are performing reasonably. For a small manufacturer in Coimbatore, this shows up not as theory, but as higher input costs and tougher hedging decisions.
People hear weak rupee and assume exports automatically win. Is that true?
Not necessarily. That's where REER, real effective exchange rate, matters. REER adjusts for inflation and trade-weighted partners. If the rupee weakens nominally but domestic inflation is high, real competitiveness may not improve much. That's why economists say depreciation is not a substitute for productivity. For a salaried middle-class household in an Indian metro, this means prices rise faster than wages, even when export headlines sound positive.
Forward premiums confuse people. Explain them simply.
Think of forward premium as insurance. Covered interest parity says, if Indian interest rates are higher than US rates, the rupee trades at a forward discount. When uncertainty rises, insurance becomes expensive. That's why forward premiums spiked in December. For a small manufacturer, this means hedging costs rise even before any shipment is delayed or canceled.
People ask, what tools does the RBI really have?
5 main ones: spot foreign exchange intervention, FX swaps, variable rate repo and reverse repo, open market operations, targeted liquidity windows. These are used in combinations quietly to stabilize markets. The objective is not to impress. It is to prevent panic.
Now the layer that makes this decade different. Artificial intelligence. Give us numbers.
Let's take a simple example. A company spends $1 million a year on cloud compute. At 85 rupees per dollar, that's 8.5 crore rupees. At 90 rupees, it's 9 crore rupees. A 5% currency move adds 50 lakh rupees, without adding one GPU. For a final year engineering student trying to learn AI tools, this shows up as higher subscription costs, fewer experiments, and tougher access to cutting-edge infrastructure. Currency has become a technology input.
Bring this back to people.
The fear isn't robots replacing everyone. It's compression. Same output. Fewer people. Higher expectations. Middle-class households feel cost pressure before incomes adjust. Low-income households feel inflation hardest because essentials dominate spending. These fears are rational. They are arithmetic, not imagination.
If we had to leave the listener with one idea, what is it?
A weaker rupee during an AI revolution does not doom India, but it forces a choice: build the future or rent it quietly. Understanding the system does not remove difficulty, but it restores agency.
Before we close, thank you for joining us, Dr. Lakshmi, and thank you to everyone who spent this hour thinking along with us. I'll leave you with a question. When currencies move quietly, do you notice the signals early or only when they reach your daily life? Until next time, stay curious.
Thank you for the conversation. And if this discussion made you pause and reflect, that's exactly where meaningful change begins.